Welcome to Taking Stock for the week ending the 22nd of October 2021, where today Matthew Swartz, our Senior Portfolio Manager in the Lincoln Managed Funds team, and myself, Kian Trin, stream to you all things share market. Thanks for joining us today, Matt. I know you've been quite busy, especially with the US quarter reporting season having quite an impact on the Lincoln US growth funds. And last week we alluded to this another strong US reporting season predicated on this positive trend in earnings revisions over the previous few months. Around 80% of companies have so far beaten market expectations above the 5-year historical average of around 76%.
Yeah, that's right, Ken. And look, although it's only early into the reporting period, the sector that has so far led the way in terms of earnings surprises has been in the financial space, as indicated on this chart on screen, which we can compare the actual financial results in the blue bar versus the market's expectations in grey. And leading the way have been the investment banks such as JP Morgan, Goldman Sachs, Bank of America, and Citigroup, who have all benefited from fairly buoyant financial markets and also strong corporate activity. There's potentially some read-throughs here for our banks who are set to report over the next couple of weeks, particularly Macquarie Group, who tend to benefit from similar drivers as the US banks do. And the positive start to quarterly reporting period has no doubt fueled this snapback in equity markets over October, with the S&P 500 now trading back to its all-time highs. But we can't be too complacent. Speculation in the market remains rife and risky trades are currently being rewarded, but we know these cycles are not sustainable. The price of Bitcoin, for example, the predominant cryptocurrency with no intrinsic value, has now rallied past its all-time highs. And meanwhile, about 60% of growth stocks in the Russell 3000 index are currently unprofitable. Yet many of these companies have generated huge share price gains. In fact, the Russell 3000 growth index has risen about 84% over the last 2 years, despite the COVID correction. Now, once this speculative mania ends, the market will revert back to quality, hence the importance of investing in financially healthy companies.
Yeah, and that's what we do, Matt. And speaking about companies that are not making any profits, this week travel booking operator Flight Centre, they needed to conduct a 500 million capital raising to sustain its operations. And we expect other unprofitable companies to follow suit, especially those in that travel and tourism industry where the opening of borders is still quite uncertain. Let's now turn our attention to our star stocks that are in the middle of the AGM season, and one of them was transport logistics company Brambles, which upgraded its revenue growth forecast slightly to between 5 to 7%, although earnings growth is expected to remain in the single digits. The company has been impacted by rising cost inflation, such as labour and shortages in timber, but has managed to offset these costs by increasing prices. Hence, we believe share price weakness may represent opportunity for investors.
Yeah, and in the past 2 months, investors would have noticed the share price weakness in metal detection and communication provider Codan. This was first due to the planned departure of CEO Don McKirk, who has effectively been quite instrumental in driving the business strategy. In addition, the withdrawal of troops from Afghanistan represents a marginal headwind to the communications segment, which contributed about 2% to its group revenue in FY21. Despite this, we believe share price weakness represents some opportunity, with earnings expected to grow by nearly 20% this year on the back of its recent acquisitions. And the company is set to hold its AGM around the 27th of October.
Yeah, thanks, Matt. And speaking about the share price weakness, Infomedia, a software developer for car servicing and parts, they announced that the current CEO, Jonathan Rubinstein, has resigned. And the resignation will take almost immediate effect, with non-executive director Jim Hassel set to take control in the interim while a search for a permanent successor is launched. Now, the sudden resignation has led to share price volatility, but the company has reaffirmed its earnings guidance for the full year, with revenue expected to rise by about 23%. The share price volatility was also driven by the stock's relatively lower liquidity levels, with an average daily trade of around 600K. We remain optimistic about the business, with earnings expected to remain intact for now, so possibly another opportunity for investors. And earlier this week, asset manager and corporate advisory firm MA Financial Group, they lifted their FY21 earnings guidance by about 40% on the back of fund inflows and fees from real estate transactions and corporate advisory. As a result, earnings growth should be revised upwards from the current levels at 19%. But investors shouldn't rely too much on the growth outlook for this stock since it has only one analyst coverage. Similarly, regional bank MyState as well, they posted a strong quarter on the back of higher loan growth and rising customer deposits. Although there is no consensus forecast on this stock, we believe the company will continue to pay the attractive dividend yield to investors on the back of the trading update.
Yeah, it's been a interesting week and a busy week with regards to positive trading updates. Firstly, BlueScope Steel, who increased their EBIT guidance by about 15%. South32's production quarterly was really solid, with the company maintaining full-year production guidance. Perpetual Asset Management also had an update yesterday, which was really well received by the market, with the stock powering about 7% ahead at yesterday's close. And taking into account protracted lockdowns in Melbourne and Sydney, having to cycle huge sales growth last year due to the stimulus spending boom, Super Retail's trading update was fairly solid and largely ahead of expectations, with management fairly upbeat on a Christmas surge. All of these stocks are held in the Lincoln Australian Growth Fund, and these companies have contributed strongly to the strong month that we're experiencing to date.
Yes, some solid updates there, Matt. But turning our attention now to the corporate calendar, ANZ is expected to kick off the bank reporting season with its results due around the 28th of October. Also, Macquarie Group, they are expected to release their results on the 29th of October. And of course, AGM season continues next week with a raft of trading updates. So please refer to our calendar for more information. Meanwhile, under Golden Rule 4, for highly trend-sensitive investors, we have a series of bearish ST Max signals from ASX Limited, Charter Hall Long Whale, Fisher & Paykel, ResMed and Spark New Zealand. Positively though, a recent addition to the Star Growth Stock universe, Aurelia Metals, they triggered an entry on the SD30 TSR, which is Stock Doctor's 30% stop loss re-entry indicator for the moderately trend-sensitive investor. In Under the Microscope this week, we take a look at casino and online gaming company Aristocrat Leisure. The company has a long history in pokie machines, but branched out onto the online gaming sector in 2017 with the acquisition of Big Fish and Plarium. And this was well timed, especially because COVID prompted the closure of casinos worldwide and helped drive the demand for social gaming online.
And the company is set to increase its digital segment, with this week announcing the acquisition of UK gambling software supplier Playtech. The purchase price is sizable, 5 billion Aussie dollars, which is about 17% of Aristocrat's actual market cap. The acquisition should see a spike in its debt, which may impair Aristocrat's financial health, especially given that its total liabilities to total tangible assets ratio is already elevated. We will monitor the timing of the cash flows from the acquisition to offset the weakness in its balance sheet. And following the acquisition, the digital segment is expected to rise to 69% compared to 57% in the last financial year. And within this segment, 49% will comprise online games, which while 29% should come from betting and gambling.
Yeah, Matt, and positively, its full-year guidance was slightly ahead of market expectations, and this was driven by the opening of casinos, allowing land-based gaming machines to be installed and leased. And revenue from the digital segment was also ahead of expectations as well. And earnings should also benefit from the lower Australian dollar to US dollar exchange rate in recent months. As a result, earnings growth is anticipated to recover strongly at 77% for this financial year, and the company is expecting to report its results next month around the 18th of November. Now that our transition towards our optimized Star Growth stock model is complete, a pertinent question among our investors is how should they construct a portfolio from our Star Stock universe? To remind our investors, our Star stocks, whether they are Star Growth, Borderline or Star Income stocks, now need to pass Golden Rule 1, financial health, Golden Rule 2, past financial performance, and Golden Rule 3, outlook and active risks, our qualitative assessment.
So this means that we consider all these companies as quality businesses regardless of their overall size. So in effect, a quantitative algorithm is now choosing the star growth stocks and it's ranking the stocks on their past financial metrics. The ranking system has shown to add significant value to portfolios over the longer term, but all R star stocks, whether they are star growth, borderline or star income, are of high quality. They are also being assessed on their active risks, including their competitive landscape, probability of having strong financial health moving forward, management, and change to analyst earnings forecasts.
And if you want to replicate the star growth stock performance, you can simply invest in our star growth stocks, which have been back tested over time. Just set up your alerts in Stock Doctor to inform you of the changes to the portfolio over time. The other option, though, is to construct your portfolio from our star growth, borderline, or income stock selection. We have 63 growth stocks and 40 income stocks to ensure there is sufficient liquidity across our membership base. You can select from a variety of these stocks depending on your investment objective or risk profile. And to manage stock-specific risks, it's important to maintain a well-diversified portfolio of at least 15 stocks.
And use our secondary golden rules to help you construct your own portfolio. Golden rule 4, for example, if you are quite trend sensitive and only want to invest in uptrending stocks, then you can use our technical indicators such as SD Max or SD30 TSR. Otherwise, you can apply a wide selection of indicators from our charting tool. Are you share price value sensitive? Golden rule 5. If so, be careful when buying stocks that are trading at significant discounts to valuation, because these stocks usually have higher earnings risks and can lead to some value traps. High quality businesses tend to trade at a premium to valuation, so it's better to look at the trend in valuation over time rather than absolute relative value. You can find the trend in valuation in Golden Rule 4 in our share price charts. Golden Rule 6, ensure the liquidity and size is sufficient so you can buy into or sell out of the stock. And Golden Rule 7, are you comfortable with the business operation? Who are the management team? Are they appropriately paid? Do they have skin in the game? And Golden Rule 8, be proactive in managing your portfolio by keeping track of the company's announcements.
And of course, feel free to contact our analysts if you are unsure about a particular company, particularly around its active risks. Okay, thanks, Matt. That's all we have time for today. Appreciate your insights.
No, my pleasure. Thanks for having me.
So the strength of the third quarter US earnings results and the Australian AGM season has helped allay investor fears leading to the recovery in equity markets. But along with the tide, many companies with weak fundamentals and a lack of profits have continued to rally. And to sustain operations, these companies will need to raise capital, just like Flight Centre this week. So we need to be vigilant, ensure we invest in financially healthy businesses, because all boats float in a rising tide. But as Warren Buffett said, it's only when the tide goes out do you discover who's swimming naked. Stay safe and have a happy, healthy, and prosperous week, everyone.